Well, as you know, I love the auction clearance rates and love hearing where they're going. One point to take note of for those people out there thinking about selling over the next little while is that the number of people going to auction at the moment are quite low, and I reckon it's a very good way of selling your property and certainly generating interest in your home. And certainly over the next couple of months, I hope a few more people pick up the opportunity and run their property to auction, because they will be pleasantly surprised in terms of the time it takes to get a sale result, and hopefully with the result indeed. Now, we have in the studio with me Anthony Keane. He is the editor of the My Money section in The Advertiser, and of course with News Limited. Anthony, how are you?
Good, thanks. Tim, how are you?
Very well, thanks mate. Good to see you.
Yes.
Let's get things started and of course talk about the excitement of the moment, the 0.25% reduction on interest rates. How are you seeing that affecting the market over the next couple of months?
Yeah, it surprised me that they actually cut. In the past, I've sort of been hoping for cuts, and they haven't tended to follow through with them, especially so soon after we had the half a percentage points cut just a month ago. So look, I think it's great news for home buyers, great news for people with mortgages, but what it does say is that they are worried about the economic problems that are happening all around the world, particularly in Europe, and that flowing through to our markets again.
Yeah. So as you said, 0.75% over the last 2 months. I guess from the little spot we sit in real estate wise, we're happy because it means affordability to purchase grows. Investment wise, I guess the return on investment effectively grows as well, with rent staying high and purchasing a little lower. How do you see the market performing over the next 6 months, I guess?
I think to see a big turnaround in the market, we're probably going to need to see more cuts, which may happen. Here in Australia, we're lucky, our Reserve Bank has still got a lot of room to move with the official interest rate. Now we're down to 3.5%. But if you look at some of these countries overseas, the US official interest rate is about 0.25%. In Britain, it's 0.5%. Europe's 1% for the whole of Europe. So they haven't really got anywhere to move. And that's why some of them are resorting to printing money to try and get things happening. Whereas we can still have some sharp cuts. And if we do have those, recent history from the GFC back in 2008-09, when our cash rate was cut by about more than 3 percentage points in a few months, that sort of was the fuel for a nice rally we had in house prices during that period. It's not to say it'll happen again. Every crisis is different,
Sure.
we know, but it could be, it could be what some people could look forward to.
A little bit of a stimulus, and you've got to rely on a little bit of the past history to say, well, when that happened, the result was, and hopefully that does happen. I guess the next question I had was, how does the interplay of reducing interest rate affect the long-term or the longer-term lock-in rates for banks and so forth at the moment?
Well, yeah, that's interesting, because fixed rates are at really low levels at the moment. They're a pretty big discount to the variable rates. I think I read around the 1.2 percentage points cheaper. A year ago, they were only the difference was about half of that. So great news for locking in fixed rates, and a lot of people are doing it. I think the latest Bureau Statistics data was showing that it's at a 4-year high for people fixing their home loans. But you do have to be careful and be happy with the rate that you're getting, because if we do have a big global financial catastrophe and our Reserve Bank cuts by another 2 or 3%, that's going to make variable rates a lot cheaper than what you might be locking your fixed rate in now. Look, if you're happy with the peace of mind and the fixed rate, that's fine, but you could potentially miss out on some of the gains, but that's obviously worst case scenario from the global financial side of things as well.
Okay, and just as an aside, I saw in the US you can lock in for 30 years at 2.84%, which just is mind-blowing.
It is, yeah, exactly.
Just incredible.
You'd think, yeah, well, we're talking 2 and 3 years here, although with the amount of times that people will often change their property over their lifetime, there might be some issues there.
Some penalty
Yeah,
rates.
often when you leave a fixed rate loan, if it hasn't paid out if it hasn't sort of played out the whole length of the loan, you
Yep.
can be hit with break costs, and they can go into tens of thousands of dollars on big loans, as a lot of people discovered back
Yeah.
during the GFC.
So just a point that you made earlier about the fixed rate, at the moment with it, you said it was quite a lot lower.
Yes, yes.
That would forecast that banks are perhaps expecting interest rates to fall
It
a little
does,
further.
yeah. That suggests that they know something that we don't know. I mean,
Yep.
when you're gambling on fixed versus variable rates, you're gambling on your view of the future being different than all the experts that the banks employ to set their fixed rates.
Yeah.
So it suggests that they're thinking it might go lower. And also that 1.2% gap is narrowed a lot when you look at most people with a home loan shouldn't be paying the standard variable rate. There's
Yes.
a whole variety of packages that you can get from your banks out there, whether it's 0.7 or even 0.9% off of your standard variable rate. You can haggle a bit and get your loan sort of down as well. So it's, you can get a pretty good deal with variable or fixed at the moment.
Yeah. So from our point of view, great news real estate wise. On the other side of the equation, I guess there are people who would be preferring interest rates were heading north rather than south at the moment.
Oh, that's exactly right. I mean, the retirees and who are relying on cash in the bank, and even people that don't have mortgages and loans who have got cash deposits. I mean, they're seeing the value of their deposits fall sharply.
Yep.
Because obviously when the Reserve Bank cuts rates, it's not just the home loan side of the equation, it's the savings side of the equation. And the banks have been mentioning this in their announcements in recent months, saying we're doing this and we're minimising the effect on savers as well. Because
Yep.
really, if you're a retiree, you're getting hit on all sides at the moment. If you've got an investment property, the market's down. If you've got shares, the market's really down, still 40 to 50% below where it was sort of 5 years ago. And if you've got cash in the bank, which is the safest place, returns on that are down as well. So there's nowhere to hide at the moment.
No. Well, let's try and find a silver lining, because my guess is that if we were able to get a little bit of a spike in prices moving forward, anyone who was looking at retiring and had property as well might be able to sell out of that rather than their shares and whatnot, sell out of that and make a little bit on the way through.
Yeah, exactly.
Keep our fingers crossed. Anthony, hang with us. Now we're going to go to our Going, Going, Gone segment.